Hey everybody, this is Brent from Wolf on Wall Street Trade with a market update for the week ending March 27th, 2020. If this is your first time visiting my channel, thank you. And generally what I do is pick up where I left off with the prior video, which was last weekend. S&P was down 15%, just so we have like a running story, some context to put all this into. So here is a brief clip. You can check out the video, but here's a brief clip in summary. So we have a little bit of improvement in a few areas. Volatility is starting to break trend a little bit. Saw some flashes of credit looking better here and there for brief moments. We saw small caps leading a couple times this week. We saw some cyclical sectors acting better. So these are all changes in character, and changes in character precede changes in trend. Okay, so changes in character precede changes in trend. It may look like a V-shaped bottom. We'll look at it a little bit closer. S&P 500 was up 10.25% this week. It was the first time in 5 weeks the S&P has strung together more than one green close consecutively, got 2, 3. And this is what you call a bear market rally. It is a bounce or a rally to a lower high. So the primary trend is down. And these bear market rallies are some of the most impressive you will see. So you hear a lot of stats like it was the best day since 1932, or the worst day, or the worst 3 days since 1932, stuff like that. It used to be, a couple weeks ago, this was the best or the worst since the financial crisis. Now we've got the kind of volatility that we're seeing way back in the Great Depression. Here's the S&P 500 from the financial crisis, by the way. Here's where Lehman went belly up. So the last couple of videos I've been saying the Fed is not moving the needle at all for the market, and this is just what happens when you get into a bear market or a late stage market. The Fed goes from omnipotent to impotent, and what the market really wanted to see was this stimulus bill passed by Congress. So I had been saying that I think we're going to probably have a scenario like the TARP rally from 2008. So just like now, at first, Congress didn't pass it. The market was disappointed. Then they passed it. And this was about an 18% rally. It doesn't look very big on this chart, but it's huge. These are huge days. For instance, the first day over here, S&P was up almost 11% the first day of that rally. So here we are back at present day. S&P up 10.25%. The Dow Jones Industrial Average was the best performing. It was up 12.84%, the best week since 1932 for the Dow. And a big part of that was because Boeing basically had a huge week, and that's all on this corporate bailout stuff that's going through Congress right now. Here's the NASDAQ 100. It was the weakest performer on the week. It was up 8.25%. That's great still, but it lagged all the other major averages. And what we've been noticing is that on the way down, although it's been selling off, it hasn't been selling off as hard as small caps or the Dow or the S&P 500. Part of that reason is because it's packed with these story stocks, the mega caps, and it's been my opinion that investors have not been willing to capitulate and let go of those stocks yet. So on the upside, didn't perform as well. And here's the reason. So this is a 5-minute chart of the S&P 500, and this white line is my most shorted index, the stocks that are shorted the most. So you can see coming into the end of the sell-off, they're leading the market lower. And then as we come into this week, especially Monday and Tuesday, huge short squeeze on those stocks. So the takeaway is that NASDAQ and the mega caps were performing better. They had less short interest in them, so they got less of a short squeeze. And while we're here, let me show you how the week ended real quick. Zoom in a little bit. So Tuesday, Wednesday, short squeeze really driving prices higher. But then we get into Thursday, and some of you might remember on the site if you're a subscriber, S&P tried to break out over 2,600, had a rough time there earlier in the day, and it actually did. But look what happened with the shorts. They were not being squeezed anymore, so we weren't getting that same kind of upside momentum. And then as we get into Friday, no short squeeze really. And here's IWM small caps, was the worst performer on the way down, and it was the second best performer this week, up about 11%. And again, that's because there was so much more short interest here. When those shorts covered, it was a bigger rally. Looking at the S&P, it kind of looks like the market turned on a dime. But like I said in that last week's video, there was changes in character. You just had to look in a lot of different places. Usually small caps will lead the broader market. They led the market on the way down. They actually led the market on the way up. So we're going to take a little closer look. And we're going to start with VIX, because VIX was one of the first places that showed the potential for a rally. So here's VIX, and it's a 15-minute chart. You can see it up here. Put on some trend lines real quick. So the first thing we saw last week was VIX starting to break this trend. And what I had been telling my clients is that basically you're not going to get a real strong rally until this trend of volatility breaks. So this was the first thing for a potential rally. That's a change in character, and it led to this change in trend. More broadly, it led to the change in trend for the market this week. Another thing we noticed last week was market breadth. So this is a daily chart, the S&P 500, and below is the NYSE number of new 52-week lows. So as the market is selling off, it does what you'd expect. The new lows are increasing. But as we got into this prior week, if we take a closer look, what you see is the market still moving down, but there's fewer and fewer new 52-week lows. So that means the selling pressure is less worse. So that was another change in character that we had seen the preceding week before this past week. And then finally in price action itself. So here's the Dow. This is that big first leg down. And here we are into another one. So I'm just going to kind of walk this forward. And we come into this week and it was actually pretty ugly on Sunday. So I had put out 2 new downside targets. The first one was 18,430 and we hit that on Monday. And there was a second one that was actually lower down here at 17,500. So the fact that it didn't hit that second one was an improvement, but from price action alone, there was no reason to believe it wouldn't go lower as far as the Dow anyway. Let's take a little bit closer look. And you can see the time frame up here. So Dow 5-minute chart. This is Monday making a lower low from this bear flag, doing what you'd expect. But if we look at small caps, and small caps tend to lead the broader market. Let me pull up IWM. Look what they were doing. They made a low. I think this was, last Thursday. Did not make a lower low. There's the low. Did not make that lower low. So small caps were starting to show what you call relative strength. This was the first hint of improvement in price action itself, and that came from small caps, and it also came from Dow Transports. They also made a higher low. Now Dow Transports tend to lead the Dow Industrials, and that is the whole genesis of the rally. If I walk the chart forward from there the rest of the week, there's your rally. Now, if you don't have time to watch the charts like I do, which is all I do, what you can do is look at the relative performance of one sector against another or one average against another. So this is Dow Transport's relative performance to the Dow Jones 30 over here, this blue line, and you can see transports had been leading the market lower. They were acting worse, and as we come into this past week, they started acting better. You can do the same thing with small caps versus the S&P 500. It's one as a ratio of the other, that's all, relative strength. And you can see small caps leading lower on the way down, but when we come into this week, they're showing better relative performance against the S&P 500. And you can watch this intraday. It's the first thing I do when the cash market opens. I look at the S&P 500, I look at small caps, I look at all the averages, I look at all of these sectors and say, okay, well, the S&P is down 5%, but small caps are only down 3%. They're showing better relative performance, and you'll see that on this kind of a line too. It's that same concept of changes in character lead to changes in trend. The change in character was small caps were the worst performing. All of a sudden, they start showing relative strength. Volatility broke trend. It opened a window for the market to rally. We saw the selling getting less worse by those 52-week lows, which coincides with small caps starting to act better. Getting down to a more granular level or nitty-gritty, here's the 5-minute chart, SP 500. Here's how it came into the week. And if we walk forward, so Monday or Tuesday, Wednesday, short squeeze driving the market. By Wednesday, we could get a trend. So I connected the low of Tuesday over here and the low of Wednesday. So we got an idea of the short-term uptrend, and I had put in some trend lines where I expected this kind of big broad range to come into some resistance. And that was right here around 2562. So we did get a little bit higher and tested into this 2600 level on Thursday. Let me zoom in just a little bit closer. So here it is Thursday, and remember, by Thursday, the short squeeze was starting to die off. So testing in the 2600 had a little bull trap or head fake or whatever, and kind of came down. But then towards the end of the day, it finally did move through it. And on Friday, we got a change in character again in having broken this short-term uptrend. And then fairly early Monday morning, I could see quite a few sectors were putting in bear flags, and that's pretty much how the rest of the day went. So one of the things I was thinking about Friday morning was, well, maybe I'm going to take a shot at this on the short side since we do have a bear flag. But what I figured was if I put a stop up here and I figure out what the downside target is, my risk reward or reward to risk was about 2-to-1 ratio. I usually look for at least 3-to-1. I get excited about like 6-to-1, 7-to-1. So it didn't look that exciting to me yet. And I said, to my members, my subscribers, if it gets higher up in this range, up towards the 2600 level, then the risk reward proposition looked a lot better. And if we just go through the rest of the day, gets up into this 2600 level, this is where I went short late in the afternoon. This is just a small short-term trade because it is another change in character from an uptrend to a failure to break out above 2600 and this little bear flag. Same thing in all the averages. So if I go to the Dow, You can see uptrend over here, has some resistance, tried to break through late on Thursday, broke this uptrend and a little bear flag. Now it's still above the top of the range, so this is kind of where I would expect the first area of support. I have a downside target for this. It's not huge, it's like 4-5%. But the point I'm getting at is the change in character again in the price trend, IWM or small caps. You can see a bullish trend over here. You can see a bullish flag over here and an attempt to break out over here, and that failed attempt leading to a bearish flag. So it's a small change in character towards the end of the week. And remember, happened just as the short squeeze momentum was running out on Thursday. So with that, let's take a look at S&P sectors real quick. So most of these are going to be 15-minute charts. You can see the watermark here of what sector it is, time frame up here. This is XLB, the material sector, lightly weighted sector, but it's growth sensitive. It was one of the first ones to put in a low and not make a lower low. So when I was saying to members, especially during this week, I expected prices to come up towards the top of this range. This is what I was trying to identify. So we have bear flags here, bear flags here. You can see the change in tone, the change in character to not making lower lows, to starting to do a sideways pattern and then making a slightly higher high relative to back over here. And again, like most of the market on Friday, had this little bear flag. It's not a huge bear flag, but it does suggest that we get a little bit more of a pullback and maybe into the middle of this range, which I think would be more constructive if you're bullish on the market. The way I look at it is a market to rally, it has to have a good base under it. Like if you build a skyscraper, you want a solid foundation. This little bear flag doesn't suggest a 15-20% crash. It suggests a smaller kind of pullback coming. Then we see how that pullback acts. And if it acts like this with another bear flag, then I let it run. If it doesn't, then I take my profit at my target. Here's the energy sector. Again, over here, a higher low. Now this is a bear flag, started as a bear flag. It broke out above it, so that is some improvement. Instead of saying, okay, we're just got another bear flag, get ready for another leg down, it's an improvement. You can see intraday on the week, a little bull flag over here, but then you can see the tone and the character change to a bear flag. Here's the financial sector, XLF, really not a lot of improvement here. And then this is just all short squeeze. There's no structure in here. There's no kind of range or base developing. Bearish flag on Friday. Within financials, here's regional banks. They looked more like a bear flag. It's a little bit big now at this point for a bear flag. It's really just this short squeeze rally, and you see this small bear flag. So yeah, it could come down to the lower trend line, maybe a little bit below, and then we'll see what we have from there. Here's industrials. You see the bear flags coming down. These are telling you, we have more to go, more to go. They get smaller because there's less of a bounce. People are just selling. They're not like, okay, let's see if this is maybe the bottom. They're just giving up hope and selling over here. This is just a counter trend rally short squeeze. There's no real structure there. Ends with a little bear flag. Compared to industrials, transports look better. Transports tend to lead industrials. They made the higher low over here, kind of broke out above this range and pulled back to it with this little bear flag. So again, there is some initial support right here. We'll see if prices hold up here or they come down a little bit. And here's the technology sector. This is the second leg, so there's a whole another sell-off back here. But what you can see is early on in the sell-off, people are really willing to buy a lot more. You can see how this flag is steeper. They're kind of thinking, well, maybe this is the bottom. This is the V-shaped bottom CNBC's talking about. And then as the sell-off goes on, you can see the flags or the corrections are not as steep. There's less enthusiasm. And at this point, it's not even a well-formed flag. It just kind of sustained selling over here. And like all those other sectors, a little bear flag over here on Friday, but some potential support, at the top of this range. Let me just point out something real quick. This is Friday's loss, 4.5%. Now I'm going to go to semiconductors. And you can see on Friday, their loss is 5.3%. So they're starting to show some relative weakness versus technology as we get in this bear flag over here that is kind of coming down. This looks more like a bear flag. So I think there is some potential maybe to trade down towards the bottom of it, about 1,400 for stocks. Some of the defensive sectors like consumer staples, 3 bear flags. This is not a really well-shaped bear flag, unlike this one that kind of comes to here and then you get your angle. This one kind of comes here, bounces up, and then you have this angle. It is a bearish consolidation, but it's not as bearish as some of these other bear flags. Another defensive sector, utilities. This is just a massive short squeeze. Here's the real estate sector. This is just an unbelievable short squeeze. And here is, I think that's Tuesday, Wednesday. That's a short squeeze. There's no pullbacks in it. It's just shorts covering. So essentially the shorts that were riding this got squeezed. They're covering. That's a lot of what we saw in the market this week. And this is why you get these spectacular bear market rallies. Here's the communication sector. Again, a little better relative performance in making a higher low, but I cannot rule out that this is a big bear flag. Cannot rule that out yet. Here's a little one on Friday. If this was a big bear flag, this would be really, really scary. Here's why. Sell-offs occur like this. You get a steep, this is the flagpole, the waterfall sell-off. Then you get a consolidation. That is a bear flag. It's a parallelogram that consolidates away from the preceding trend. That means it consolidates up like this. Usually they're pretty tight and compact, and it is kind of like a midway point. Usually you get one leg down, consolidation, and a next leg down, which is what happened here. So at that point, what's going to happen? Do we see better price action? No, we see another bear flag, right? And price comes down again. So if this is a big bear flag, this would suggest that this may be the midway point between a second leg of either this much or this much. Either way, you get into double digits, into like the 30% range. What you would be talking about if this continues to develop like a bear flag, and if it is a bear flag, it would probably develop a little more structure, make it clearer that it was a bear flag. But what you'd be looking at from the point that it broke below this consolidation is a decline on the order of 25 to 33%. And depending on where it broke, if it broke earlier back over here, you'd be looking at something along these lines. That's a huge another sell-off. And if this sector is going to do it, the whole market's going to do it. We'll see how it develops. We'll see how it performs. But this could be a much bigger bear flag like these over here. We'll see. In consumer discretionary, it's another sector that has a lot of those FANG names, those mega caps, like communications, like technology. It too has something that looks like a very big bear flag developing here. So here's the first leg down. Here's the second leg down with a small bear flag between. If this is a big bear flag, then we could be looking at a whole another leg of this, or of basically this. Alternatively, what could happen is prices do something like this, kind of maybe come down in a slower fashion like this, not a big sharp sell-off, and test a low over here and have like a W bottom, then could rally more from that. We don't know that yet, so we just know what price is doing now. Last weekend, I was really trying to press this point of, my job is not to forecast, look, this is going to end at 1,800 for the S&P 500. My job is to pay attention to what prices are doing now, what prices are telling us now, and if I can get a target, like when we get this kind of bear flag, I put out those targets. So far, price has been really accurate in meeting them, not to the penny, not to the dollar, but enough to know that when you see something like this, you should not be buying it. Okay, so the takeaway is you can see a lot of different patterns in all these S&P 500 sectors. If they start showing the same pattern, then we get higher probabilities. But right now, it's just kind of a disaster. Some look like a bear flag like this. Others, like materials, have a little bit more of a base. Jumping back to IWM, there's good and bad things. As far as macro signals, like what I call the message of the market, there's good and bad things. So what I do is weigh the probabilities. Are there more good or more bad things? And if I don't know, I just stand aside. But one thing I want to point out is Friday when we did get this bear flag, if you look at volatility, we had a change in character there. So here's the first break of the trend that opens the window, opens the door for the market to rally because volatility is coming down. But if we look closer on this week, as we get into the week, more bullish price action in VIX and volatility kind of started to break out above this consolidation over here, came back in, and then on Friday it did break out with still a bullish consolidation here. It's pulling back, but it's still a bullish consolidation. So this is telling us that window of opportunity might be closing. Volatility might be getting ready to pick up. So it's something we want to pay attention to. You can see it did close out the week above this trend. And on a week that the S&P gains 10.25%, VIX was down less than 1% on the week. If we look at the S&P 500 on the week here, and here's our rally, and then we look at the 10-year yield, what the bond market is saying here is like, we're not buying it. We're not that interested in this rally. It's not the real thing as far as the bond market's concerned. And what happened towards the end of the week is that yields broke down over here. So this was a little bit more of a negative development. That's one of the reasons why I took this little bear flag a little bit more seriously Friday. This is crude oil, or USO in red. So early on in the week, what I was saying, crude oil was participating, but it wasn't really that excited about it. Same thing as the bond market. And what I said was be mindful, watch this trend over here. And you can see the trend was broken on Wednesday and certainly on Thursday. We got a real bad sell-off in crude. I think it was down almost 10% on the week. Here's USO 5-minute chart. Here's the 25th. Came into the week rallying, and then we just move forward, but not showing great relative strength versus what the market was doing. And then as we get into the end of the week, there's Thursday. had broken trend, little bear flag. This was prior support, became resistance, and then here's Friday over here. So the point being is that crude oil and the bond market were acting ugly towards the end of the week. That went into my decision to sell short. The potential downside from basically this point where it broke down is about another 32%. The price pattern looks bearish, but if it can find support there, then maybe we avert that. But if crude breaks down over here, then the probabilities that the whole stock market follows go up exponentially. So here's a 15-minute chart of WTI crude futures, and you can see that same triangle that I was just talking about on USO over here. And let's see if I got it perfect. You can see the kind of breakdown over here in WTI crude futures. So what you'll want to be watching is the low over here, which I think is around 2080, and then back over here, which is 2052. If crude continues to break down below that, then things are going to get real ugly for the stock market real fast. And if we go back to that chart of USO, the triangle here, and I overlay the 10-year yield on it, the bond market is kind of acting the same. So this is definitely a risk to be aware of next week. And with the dollar down, gold got a reprieve this week, so it was up. And what I had been talking about recently is how bullish until we got over here where volatility just exploded. And here's gold's volatility. So it's still really high, and that makes gold a lot more difficult to trade in, to invest in, because you get these moves that are just, they're too volatile, up and down and up and down. So it did improve this week, early this week. I think Sunday night triangle, which suggested, is coming to an apex. It suggested gold is going to move one way or the other. So it moved up, and this is a pretty nice move up. It was a lot more than I expected. And what I'm hoping to see is that it continues to consolidate like this and that volatility comes down. I would rather see gold consolidate, maybe even pull back a little bit and just see the volatility come down. I think that would be more constructive. But this looks pretty good for gold as far as this week. Again, I want to see that volatility come down. Another thing I mentioned early this week was the Australian dollar. So the dollar's coming down, the Aussie's doing better. And you can see it has been trending up. It's been making higher highs over here. So this has been constructive. If this did start breaking down, say below this 0.60 level, with crude and with the bond market doing what it started doing late last week, I'd become a lot more concerned for stocks. So the kind of line in the sand I'm watching is this 0.60 level. Above is a little bit more constructive for risk assets for stocks. Coming down would be more negative. But I have to give you some perspective. This is a correction too. It's a bear market rally or bounce. So this is what the Aussie looks like on a daily chart. So this is that little bounce we're looking at over here. And if we look at S&P futures here in red and green, and here's the Australian dollar versus the US dollar in white, you can see it did improve too. Around the same time we saw improvement in small caps, in crude started its bounce, stuff like that. So it's been rallying up. I take this more as a sign of just risk sentiment. So risk sentiment has been more positive, and part of that is the dollar getting crushed over the last week. This is initial claims last week. This is recession shading in gray. So if you look back here, this is the financial crisis. This is how bad unemployment got, or initial claims. This is without precedent. And in states like Florida, you have to wait a week before you can even file. So this is kind of like California. California shut down before everybody else. So you're seeing California in here. But places like Florida, where they shut down after this was taken and you have to wait a week anyway, we're going to see initial claims get a lot worse. And this is just without precedent. We're getting into like Depression era claims over here. And while this is not a financial crisis, and people point that out rightly so, it can lead to one. So the real crisis that I've been expecting when we get into a bear market is a debt crisis on the corporate side. They've just been pigs at the trough, filling up on cheap debt. Some airlines using 95% of their cash flow to buy back shares. Other corporations literally paying out dividends by financing it with debt. Just this week, Delta Airlines, their credit rating was cut from investment grade to junk. Ford was cut from investment grade to junk. Moody's, I think, put GM on watch, negative watch for a possible ratings cut to junk. And while the dollar did come down, it seems like the Fed is, having some effect there. There's still some real bad signs of illiquidity. So what we're looking at here is the TED spread. And during the financial crisis, which is back here, this is the recession, this acted as like a leading indicator or proxy for stress in the financial system, specifically banks. Banks weren't lending to each other. So this is like the highest level it's been surging even this past week, the highest level in 11 years back since the financial crisis. So even though the Fed is doing their thing, you're definitely seeing signs of stress. This could turn into a financial crisis. So good rally on the week. We did end with an inside day here on Friday, which suggests a loss of momentum. S&P's up 10% for the week, but Off this low, it was up over 20%. So on days the market's up, you go on CNBC and all you hear about is the bottom in yet? I just want to make clear this is a counter trend rally. It is a strong rally. It's impressive, but it is a counter trend rally or a bear market rally at this point. Back at the dot-com bubble, back here when it exploded, this is NASDAQ 100, there were something like 5 counter trend rallies that were over 20% each. So the financial media has this ridiculous, just asinine metric of if the market's down 10%, it's in correction. If it's down 20%, it's a bear market. If it's up 20% from the low, it's a bull market. So according to the financial media, last week we entered a new bull market. That's just ridiculous. Back in 1929, after we got this first crash, the Dow put in about a 50% rally over, I think this was 5 or 6 months. That's why they call them sucker rallies. They suck people back in. You'd be convinced that this was just a fluke if you saw the market rise 50% in 5 months, but it was to a lower high. And then eventually the Dow just kept on going. This was about an 80 or 90% loss. We have something that could be conceivably a base over here. And if this is, then I can get a measured move, and that gives me a target basically of about 15 to 20% higher from over here. And if we apply that to the S&P 500, which I'm not really comfortable doing because there is not a base here, if we transpose that and kind of adjust for relative performance, you could be talking about something up in the 2850 area, maybe 2900. In my opinion, I think you would need to see some kind of retracing and just kind of building some base and some structure in here to support such a move. Small caps or Dow Transports, they have a little bit more of that structure going on. But in the very near term, like we saw Friday, this kind of change in character from a bullish flag to a bearish flag. It's not a horrible bearish flag, so I'm not looking at it like, this is the start of another 20% leg down. But it is a change in character, and it was enough for me to want to get involved. If I saw a few more things happening, like I saw high yield credit breaking down again, if I saw the Aussie come down, stuff like that, then I would get a little bit more aggressive with my short position. I would add to it in size. But right now I have, enough reason to dip my toes into the water. Okay, so this video has gone way over what I intended, so let's wrap it up here. If you have questions or comments, please leave them in the question comment section below. If you want to check out some of the free posts, there's a link to Wolf on Wall Street Trade in the comment description. We also offer a subscription there, so check that out. It's not a lot of money for the amount of content you get every day. And don't forget to subscribe. Down here, lower right-hand corner, there's a subscribe button. And thank you very much to everybody who's been sharing the videos and getting the word out. I put a lot of work into these videos. I would do them anyway for my members, my subscribers, but I try to add a lot of extra context for the public so you can see something at least once a week and kind of get an idea of what we're looking at. And hopefully it at least gives you some concepts and some ideas to chew over. Take what you want, leave the rest, as I always say. Everybody, thank you so much. Have a great weekend, and please stay safe. Members, I will see everybody on Monday. Unless something happens on Sunday night, I'll have another post. Thanks, everybody.